If you work from home, even part of the time, there's a good chance there's a tax deduction available to you that you're not taking advantage of. The home office deduction makes a lot of people nervous. There's this myth that there's a red flag for audits or that the rules are too complicated to even be bothered with, but neither of these things are true. So today I'm going to clear it up for you. Welcome to Cash Grab from Benchmark Ledger Solutions. I'm Kimmy. Today we're breaking down the home office deduction, what qualifies, how to calculate it, and how it actually reduces your personal tax bill. The IRS allows self-employed people to deduct expenses related to a portion of their home used for business activities, but there are two rules that you have to meet. Rule number 1. Regular and exclusive use. The space must be used regularly and exclusively for business. That means your dedicated home office qualifies. The kitchen table where you sometimes open your laptop does not. So you're really going to have to do something that is exclusively used for business. The IRS takes exclusively very seriously. So the guest bedroom that doubles as your office does not qualify unless you can make a compelling case that is used exclusively for business. For example, you have not had a guest over that entire year and you've transformed it to a home office. Rule number 2, principal place of business. Your home office must be the main place where you conduct business or a business you meet your clients regularly. So you can make your home-based business be your home-based business because you conduct your business there, like your office is based there. You have clients meet there regularly, so they maybe come for consultations or to come see you if you're a masseuse or a hairstylist. And for most home-based business owners, the first one applies a lot easier. Okay, so you have a dedicated home office. How do you calculate the deductions? Say that 10 times fast. The deductions. There are two methods. The simplified method is you deduct $5 per square foot of your home up to 300 square feet. So the maximum deduction you can get using this method is $1,500. The benefit is that it's very easy to calculate and it requires minimal record keeping. Alternatively, you can use the regular method. This means you figure out what percentage of your home's total square footage your office takes up, then apply that percentage to your actual home expenses. So your rent, mortgage interest, utilities, insurance, so on. This often results in a larger deduction, but requires a lot more documentation. So if you have an accountant, you can talk to them about doing itemized deductions and writing off your home office this way. If you're renting, the regular method is often worth it. If you own your home, there are some nuances around the depreciation that can be a little bit complicated. It's worth talking to your accountant before claiming it, but sometimes the simplified method's the best way to go. The audit myth, by the way, is outdated. The IRS processes millions of home office deductions every year. Taking a legitimate deduction is not what is going to be a red flag. What's a red flag is claiming a deduction you don't qualify for. So just make sure that you genuinely meet the exclusive use requirements and you have proper documentation to back up all of your filing. Here's your grab. Your home office qualifies if it's used regularly and exclusively for business. It has to be a dedicated space, so not a shared room or kitchen table or something like that. Number 2, the simplified method is $5 per square foot, up to $1,500. Easy, clean, no extra math. Number 3, the regular method, applying your office's percentage of your home to actual expenses, often yields a higher deduction and is worth calculating. This episode is from Benchmark Ledger Solutions. If you're not sure which method makes more sense for your situation, our team runs these numbers for business owners all the time. Visit benchmarkledgersolutions.com. Next week is another tool spotlight. We're going to be looking at Keeper Tax. It is an app that finds personal tax deductions that you're probably missing. We'll see you next Monday.